All right, Cash Flow Tactics fans, we're back in the mind map. We're in step 2. We're in the 4 pillars of the black box. You want to scroll over, Ryan? Pop open the black box. The ultimate tool of the wealthy. Here come the 4 pillars.
All right, guys. So we're going to kind of take this back. We're going to go into a drawing board because this time what we're going to do is we're going to build off of what we talked about last time, right? In the 4 pillars last time, we talked about the science, the art and the science of bending time. And in this movie, Interstellar, they give us a blueprint of literally bending time. And it's just about changing our perception and understanding of the rules. The rules in finance, most financial advisors tell you that you only make money in one way. You put your money in the stock market, and the only way you make money in the stock market is maybe it will go up in value, maybe not. But if we can start to change the rules and realize that if we invest in the right assets in the right way, like real estate, you can actually earn money through appreciation, cash flow, tax deductions, and leverage. Okay, so what we're going to do is we're going to actually put some numbers to this. So pillar 1, 2, 3, and 4. Okay, so let's go ahead and let's bring up a couple of calculators here. I'm going to bring up a rate calculator. You know what? I just lost my stuff there. Let's make this a little bit smaller. All right, rate calculator, and then we're going to bring up a future value calculator. All right, so all we're going to do here is we're going to go through an example, and we're going to say, okay, what if we use the 4 pillars inside of our investment model, okay? So let's do this, put these on top here. We're using Truth Concepts. Jimmy, we got to meet the owner of Truth Concepts last week, and this guy, I think, does calculators for fun, right?
Todd is the man, yeah.
He is. Now, what this whole calculator system is designed to do, and if you're a real estate investor, they actually have real estate calculators that are fantastic. It's designed to show you the truth with numbers in any decision that you're going to make. So let's go through this. Let's say we're going to buy a property at $100,000. And let's say we're going to hold that property over 30 years, okay? What's the standard general rule of thumb for appreciation on real estate over a 30-year time frame, Jimmy?
I mean, 3%, I guess if the Fed continues to print money out of thin air, I believe it, sure.
Okay, yeah, let's do it. 3%, that's a pretty standard if you go to the Case-Shiller Index. So if you hold a property, you buy a property at $100,000 and you hold it over 30 years, you might make 3% inside of your investing, right? And so we'll just write 3. Oh man, there goes my calculator. Let's get these back on top. You might make 3% inside of your investing. But is this where it stops with real estate? So we're going to put 3% here with pillar number 1. So if we own this property and we hold it over a 30-year time frame, right?
You didn't watch the first video, pillar 1's appreciation.
Pillar 1's appreciation, you got it. Now, pillar 2, and we're going to change the order of this a little bit. Pillar 2 is the fact that we can actually take real estate and we can use leverage on real estate. Now, leverage is the most powerful but yet the most dangerous tool in real estate. And Jimmy, what is leverage for people that are getting into real estate?
Borrowing money to acquire the property.
Okay. So if you're going to buy a property that costs $100,000, do you have to have $100,000 to do it?
No, you probably have to have 20.
All right, let's throw this in there. So we buy the same property. We hold it over the same period of time. $20,000, whoops, over 3. Let's see, let's go over here. All right, sorry about this. Let's make this a little bit different. Let's go to my rate calculator on the wrong one here. So $20,000, we went, getting my numbers back in there, 30 years, 242. All right, so we buy a property, we hold it, and it's worth 242. But now rather than having to put $100,000 in, we only had to put $20,000 in. So now our rate of return just jumped from 3% and it jumped up to 8.68%. Now, Jimmy, in a rate of return standpoint, what just happened there?
You doubled it.
Doubled, almost tripled it.
Almost tripled it, yeah.
I mean, if that's not amazing, and we're looking at it from a rate standpoint, if you could go from 3% to almost 9% by making one change in your financial plan, if you could triple your results or triple your outcome, would you not do that every single time?
Yeah.
Absolutely, right?
Yeah.
Now, let's take this one step further, right? If we can have this cash and we can almost triple it, the next thing that we get with real estate is we get the ability to earn a cash-on-cash return. Now, Jimmy, all the time when people are coming to you, this is really what we're looking for in the real estate that we buy. It's cash flow. So tell us a little bit about cash flow and what our cash-on-cash return is.
I mean, the whole name of the game is rent minus expenses. Whatever's left is yours, and you get it tax-free. It's called cash flow.
You got it. You got it.
I don't care what my net worth is. I occasionally have to look at it to show bankers, and so they'll lend me more money. But what matters is how much cash shows up in your mailbox every month. That's it.
Bingo. And that's 100%. Now, here's the thing about cash flow.
And not to bag on these calculators, but I don't really care what percentage it is. I just want to know enough cash is showing up every month that I don't have to go to a W-2 job.
Yep. Is it positive? I mean, and this is where we can kind of focus in on our efforts a little bit and say, okay, are we buying the right real estate? Because so many people got burned in 2008 because they thought the value of real estate only goes up. But here's what cash flow does. Cash flow allows us to control our leverage. Now, what do I mean by that, right? If the value of real estate goes down, if you're not cash flowing, then you're in a world of hurt. You're losing money, both in appreciation and in cash flow. And most people can't hold on for very long in that situation. However, if you have a positive cash flow situation, Jimmy, just like you did before 2008, you bought property that went down in value, but you were able to hold the property and ride it out because you were positively cash flowing, right?
I mean, I didn't care.
You didn't care.
The value of a property, I call it like a water cooler or like a T-box number. It's just crap dudes bullshit about, but it doesn't actually have a real day-to-day effect.
Yeah, you got it. So let's just reverse engineer this just a little bit. If you're getting a 15% cash on cash return, and Jimmy, most of the properties that you're offering your investors are somewhere in between 10 to 15%. Would you agree?
Right, yeah.
Okay, so what does this mean? If you're putting in $20,000 and this is your down payment on this property, if we take that $20,000 and we multiply it by 15%, you would have to earn net profit after all of your expenses, $3,000 in cash flow per year to make this a 15% cash on cash return. So essentially what that means, you're earning 15% in cash flow on the down payment that you had to make. So do you get to take the cash flow and have the value of real estate go up?
Yes.
Absolutely. So let's go back to our calculator here. What if every single year we can buy this property for $20,000 down, we can take $3,000 per year of cash flow out, and it still goes to $242,000 in total value? Our rate of return now just went from 8.68% to where did it go now? 19%.
I mean, the other thing I love about cash flow is you can reinvest that into something else, which it'll really create an exponential return on that money. Or let's say you just take that $3,000 and go on a bender.
Yeah.
That $3,000 still coming back to you the next year, no matter what you do with it.
Yeah, you got it, man. You got it 100%.
Go buy a car. You could go on a vacation. You could do nothing.
So let's take this one step further then. All right. So let's say we're going to hold this property, and Brad just came into the office. Brad is the mastermind behind these calculators, right? Brad is the mastermind behind 4 Pillars. So we're taking your stuff and rolling it on here.
Awesome.
All right.
Sounds good.
So 4 pillars, right? So now if you're holding this property over a 30-year time frame, right, what happens to your cash flow? Does your rent income, does it stay steady?
You would hope it inflates with the rest of the currency.
You got it, right? So let's say you've got an average of $3,000 coming in. In fact, let's just do it this way. Say you've got an average of $3,000 coming in every single month. And if you take that $3,000 and in fact, you know what, for the sake of time, we'll just break this down. If you average it over a 30-year time frame, your average cash flow is going to be closer to $4,000, not $3,000. So all we're saying is we're raising the rent steadily on an annual basis. And now what just happened? Again, our rate of return just jumped from 3% to 8.6 now to 25%. So Jimmy, are we not starting to collapse time with this concept?
Well, you're definitely getting your passive income to equal your expenses much faster.
You got it. Now here's
when I went out of my job, and Bob's like, "Wow, dude, you really went out of your job, don't you?" I was like, "Yes." He's like, "Dude, if we put the pedal to the metal, I can have you out in a year." We had to buy 70 properties, and we were able to do it because we collapsed time.
Yeah. And that the same for me, man. When I got into real estate and I started collapsing time, I took what would have taken me 30 or 40 years, and I also got out in 5 years, right? It took me 5 years, and I couldn't replace my entire lifestyle, but I knew with my real estate cash flow, I could put food on the table, pay my mortgage, and pay my car payments. And all of a sudden, a whole window of opportunities opened up. I was able to shift out of corporate America and do something that I love doing, which is helping people like you.
Right. I mean, once you get your time back, then you can really start making some real money.
Boom, 100%. So let's add the last piece here. The last piece are tax advantages, right? If you're investing not using the IRS blueprint that Tom Wheelwright talked about, and if you missed webinar number 1, we actually went through that. Tom Wheelwright says if you are investing like an employee, you're paying net of about 40% of your income in taxes. So if you're making $4,000 in any other investment, do you get to actually keep that $4,000?
You do in real estate, but nothing else.
Nothing else, right? If you're making, so let's just take $4,000 and we're going to divide this by 0.6. You would have to make $6,666, pay 40% of it in taxes to leave you a net amount of $4,000. Does that idea make sense?
Yeah, I mean, when I was trying to quit my job, all I said to myself is I only have to make 66% of what I am making now to live exactly the same.
You got it.
That took a third of the pressure off.
Bingo, right there. And here's the crazy part, right? If you can make investing something that you do strategically, and you're not just doing what everyone else does because that's what everyone else is told to do, what we just did is we just took a 3% rate of return and we bumped it up to a 50% rate of return. Now, Jimmy, that sounds crazy, right? How can anyone make a 50% rate of return? Now, this is adding all the pillars, and this is saying there's no vacancy and no rehab on your rental properties.
No maintenance.
No maintenance. And that's not realistic. But the bottom line is for the properties that we own, and we can show you case studies on this. We did this a few weeks ago. We're making in the neighborhood of 20 to 30%.
I mean, even your biggest lying asshole on Wall Street, even Madoff didn't tell people 50% was possible.
You got it.
We're saying in a perfect world, it's possible.
Right. And even in not a perfect world, the benefit is when you have a tenant that skips town and you have to cover the rent on your own, or when something breaks, you're not coming down from a 3% rate of return. Like in the stock market, if you lose everything, right? But in this, if you go from a 50% rate of return to a 25% rate of return, that's not going to kill you. In fact, that's still a pretty fantastic opportunity. So
if you go from 50 to a 5 or 6% rate of return, you're still a hero.
You got it, man. And that's what this is all about, guys. The art and science of collapsing time, it's not working magic. It's not doing the impossible. All it is, it's playing the game of finance by a different set of rules. And the very first webinar that we recorded, there are people playing by this set of rules right now. Tom Wheelwright said that the average investor today pays 0 in income taxes. The average business owner today pays 20% in taxes. So these guys over here, they're playing the game of finance by a different set of rules. And if you're over here taking all the risk and being last in line to get whatever's left over, you're in the game for 30 or 40 years. Just settle with it. There's no way out. If you want to do it faster, it means playing the game by a different set of rules.
Give the call to action. That was pretty funny.
All right, guys. So let's do it. So the call to action, guys, is if you want a copy of this mind map, if you want to get your step-by-step blueprint formula, text cashflow to 797979 or visit our website, cashflowtactics.com. And number 1, sign up to get all this content. And number 2, go right down here and download our ebook. This ebook is a step-by-step blueprint written to tell you how to stop paying taxes and play the game of finance by a different set of rules. So that's it, guys. Join us on the next webinar and we'll keep going down the rabbit hole.
All right. Thanks, guys. See ya.